Good morning. Thank you for joining us for today's webinar. My name is Adam Heavenrich. I'm Managing Director at Heavenrich & Company. We're the country's oldest dedicated senior housing investment brokerage firm here in Chicago. And today's webinar is going to be, generally it's tips for sellers, people who are either currently thinking of selling or just in the early stages of organizing their company, things to think about, tips, and some thoughts with regards to the sale process. We have with us a good group of panelists who represent a good broad cross-section of buyers, and they represent a lot of dry powder for acquisitions for 2018. And with that, I'm going to ask the panelists to introduce themselves, starting with Talya, if you might be able to introduce yourself. Tell us a little bit about the company.
Certainly, thanks, Adam. So my name is Talya Nevo-Hacohen. I'm the Chief Investment Officer of Sabra Healthcare REIT. We're a publicly traded real estate investment trust focused on healthcare properties listed on the NASDAQ. Our focus has been acquiring and owning assets primarily triple net leased and all in the senior housing and skilled nursing space with a smattering of hospitals included at times. We are long-term holders. We are, as I said, are primarily focused on triple net investing, so we really are partnering with operators to run these facilities. And one of the things that makes us a little bit different from some of the other healthcare REITs and other healthcare investors is that our senior management team, with the exception of me, all come from an operating background and all have extensive and deep knowledge of operations. And we think that that makes us a bit somewhat differentiated as a partner to operators in both skilled nursing and senior housing. And we're about just about $7 billion total capitalization on a market basis.
Thank you, Talya. Kelly, you want to go next?
Sure. Thank you, Adam. This is great. Great seeing everybody here. Hopefully the camera's coming in okay. My name is Kelly Sheehy. I'm a managing director with Artemis Real Estate Partners. Artemis is a private equity firm. We raise money from pension funds, endowments, institutions, and we currently have two funds in which we're investing into healthcare properties. A dedicated vehicle focused on Core Plus, in which we focus on senior housing, assisted living, memory care, and independent living, skilled nursing, and as well as a small bit of medical office. We're also very focused on opportunities to acquire properties that might need turnaround, renovation, reposition, release. So we're really looking at the whole spectrum, and for those strategies, we've got roughly between 300 and 500 million of equity in which we're trying to invest in good investments over the next couple of years. As far as we look for in properties generally, we target equity recapitalizations with operators where we can acquire a property and help the operator stay in. We also look for on developments. We'll do preferred equity and other structures that might be helpful for operators to maintain higher ownership percentages in their properties. In general, we're looking at opportunities with $10 to $30 million of equity. So there's a high-level summary, and Adam, I'm sure we'll get into more stuff as we go through this call.
Very good. Thank you, Kelly. All right, Kevin, you're next.
Great. Well, I appreciate it, Adam, and thanks for the invitation and for everyone's time this morning. My name is Kevin Carden. I run senior housing acquisitions for REDICO and our senior housing operator, American House. REDICO is a private real estate company. We participate in all flavors of commercial real estate: office, retail, industrial, multifamily, etc. And within senior housing, we have acquired an interest in American House. REDICO has been around since the late 1960s, and American House has been around since the late 1970s. American House currently has roughly 55 buildings in the Midwest and Florida, and we're looking to continue our growth. I think the great things about American House are that, and REDICO, is that American House has the ability to operate in various parts of senior housing asset quality, if you will. We have moderate income properties, and then also or moderate properties, and then also very high-end properties. So we can operate throughout the spectrum. Also, with REDICO being a developer and investor, we can evaluate real estate opportunities, I think, better than a lot of our competitors. And we bring kind of a real estate discipline to looking at acquisitions and development. So I think can make processes much more smoother. And then the last thing is we're very acquisitive. So we're looking hard for acquisition opportunities, within our footprint.
Okay. Thank you very much, Kevin. Okay, with that, just to flesh this out a little bit more, we very consciously tried to bring in 3 very different types of buyers that are out there, and obviously we have a REIT, we have a financial buyer, and we have an owner operator. The purpose of contrasting their acquisition styles is, as you go through a sale process, what you're trying to do obviously is find the best fit. And so for our firm, it's very important that we literally have categorized every buyer that's out there into separate categories to make sure that we're approaching folks, depending on the disposition, that you want to find the right strategic buyer for your community. So that's important in terms of the categories, and we'll flesh that out, allow these buyers to, the panelists to contrast themselves as we go through this. To give context to this discussion, I'll briefly go over the market and where we are. We're in the 9th year of the longest bull market that senior housing has seen. The prospect remains very good for senior housing. Obviously, we've got phenomenal demographics helping us relative to other real estate categories. Senior housing looks to be strong. It's gaining credibility as its own sector within the real estate investment groups. And so that's bringing a lot more capital into the senior housing space. So for regarding the market, in 2017, it was about a $14.5 billion transaction market. While that's strong, and it probably, we're expecting 2018 to be about in that same range, it is down from the peak at 2015, which was up closer to about $21.5 billion in transactions. We are talking about sort of 2 different sectors within the senior housing market. We have the skilled sector, post-acute, and then the private pay, assisted living, memory care, independent living. And they are tracked differently. They have performed slightly differently. I would say that the skilled sector has had a little bit more headwinds this year. In 2017, with some reimbursement challenges, Medicare revenue pressures downward, as well as patient days downward. But overall, the prospects in both these sectors are strong. Just a tip of the hat to Sabra. Sabra represented $2.1 billion of acquisitions in 2017 with their Care Capital Properties acquisition, which represented about 34% of the overall skilled nursing acquisition transaction market. So they represented a lot of transaction volume, and I think they're continuing on their acquisitions as well, but not necessarily just in the skilled nursing sector. So with that market overview, I'm going to turn it back to the panelists in terms of giving them a little bit more opportunity to describe what they're looking to do in 2018, where they're looking, and just flesh out a little bit more on their acquisitions. Talya, if you want to start us out.
Sure. So as a REIT, we're focused on assets that are cash flowing typically. And most of the time that means stabilized or near stabilization. That's kind of what I would call our bread and butter type transactions. And the scale of those transactions can be anywhere from a single asset to honestly, many hundreds of millions to even over $1 billion. We recently closed in a transaction where we invested in a portfolio of over $1.5 billion of senior housing. So fortunately for us, we have access to capital through our revolving line of credit, through general access to the capital markets. Stock price discussion, we'll set that aside for the moment. So we have flexibility in terms of scale, but the real focus is on relatively stabilized assets. We occasionally look at assets that need work, whether that is fixing a capital structure or working with an operator to fix an operating structure that doesn't work. And we've taken on those risks, and we've done those turnarounds, but we've done those very selectively. They're not a core part of our business, either in the skilled or in the senior housing space. The other thing we've done in the last few years, less so right now, but we have gotten involved in development. We started doing that in 2011, really as a way to create a proprietary pipeline of acquisitions for us. So we provide a portion of the equity capital with an option to buy the asset at stabilization. And we did that on a programmatic basis with several developer operators. And we were really looking for long-term relationships, primarily with operators who were integrated or closely aligned with a developer, so that there was continuity and an alignment of interest. That was really the focus of how we structured the deal, and with a long-term objective. Because fundamentally, and I think underlying everything I've said, we are focused on being a long-term holder and creating an alignment between ourselves and the operators, whether it's in skilled or senior housing or hospitals or whatever other property type we may get involved in, because that is our fundamental objective: a long-term hold that's successful and a successful partnership with an operator.
Okay, I have a follow-up for you, Talya, because you had said that you are looking at portfolios as well as one-off transactions. With over $2 billion of transactions. It may be surprising for some people to hear that you could do a one-off transaction, pay attention to it. Would that even move the needle for someone like yourselves? Is there a specific geographic area operator that you're looking to in terms of a one-off, or is it just generally opportunistic as a one-off?
I would hate the word opportunistic, but I have to use it here. Because I think it's overused. But we are opportunistic. So we'll look at one-off transactions, particularly if we have an operator who's currently a tenant of ours in other assets, and we think this is a good bolt-on transaction for them that allows them to get some incremental scale for their management company and creates some efficiencies for them and therefore for us. So we look at it that way. We'll also use smaller transactions as a way to do an initial partnership with an operator, so that we don't do $1 billion with a new operator that we don't know at all and we have no background with. That's untested. We'll do a $20 million deal or a $10 million deal with that kind of an operator and feel it out and see how it goes. The objective would be to grow with that operator. So we may start out with a small transaction with an operator and then based on that success or failure, we'll decide how to move ahead and either grow or shift away from that operator. And honestly, we've met operators over the course of the last 7+ years when we've been in existence where we simply liked the operator. We really thought that they got it, and we had a similar view of the industry and the business and how to run operations, and we've looked for deals to do together, and that's starting from nothing, just finding things to do together.
Okay, so just kind of rephrasing that too, is that an operator who is looking for a chance to grow and a partner to help them grow, it sounds like you could be very helpful along those lines.
we definitely endeavor to do that.
Okay. Kelly, you want to give us a little bit more information, contrast yourself with Talya and Kevin?
Yeah, sure. Maybe I'll start with kind of what we look at and then contrast a little bit with Talya. Kevin will be a little easier since we don't actually run anything on our end. But first and foremost, no matter whether we're looking at, single asset, portfolio, turnaround, core, we're focused on our operator. We're a big partner-driven organization, and so if we struggle with a deal where the operator is not staying in unless we have a great partner that we feel we can bring in and transition seamlessly. That's where we start, and we've tried to build our team around that context. From an acquisition perspective, we do focus
actually, Kelly, I want to clarify something that you just said. So on each acquisition, you're keeping the operator in, or does it just depend on the acquisition? Some cases you keep them in, some cases you have an operator in that region and will replace them?
Yeah, sure. No, it is both. I mean, I started with the operator being the most important part, and if we have our druthers, we keep the operator in. We love to avoid transition turmoil.
Right.
But that being said, we are acquiring a building in March in which it's a gentleman who developed it himself. He ran it for 10 years, and that's his only building. He wants to retire, and so we have a partner in that area of the country that's going to step in. So we certainly do change operators, but that's rarely our goal going in. And so from what we're looking for, we are going more for the single asset. I think from a purchase price perspective, we love to play in that 20 million to 100 million range, which can usually get you to 1 to 3 to 4 assets. I think kind of contrasting myself to Talya a little bit, we are a private equity firm. We run it. We have funds. We do focus on distributions, but we're not forever holders. Generally speaking, though, we're depending on the investment. If it's a nice institutional asset that has good cash flow, we'll hold for 7 years. So we can be pretty long term in that regard. But we do focus on at the end of the day exiting at some point.
The asset type, does it tend to be newer assets that you're looking at?
Yeah, I think it depends. Again, we do kind of look at the spectrum, but I'd say when we're looking at our kind of more stable core type fund, we prefer newer, prefer last 7 years, but that's not a hard and fast rule. What's most important is it's got a good location, it's positioned well in the market, and even if it's an older asset, it's been well maintained, and to the extent it has deferred maintenance, we'll be sure to overcapitalize it up front. And the number one thing is it's got a great operating history and a great operator in there.
Okay. Very good. Thank you, Kelly. Kevin, you're next.
All right. So we're looking for independent living, assisted living, memory care communities, and senior apartments in the Midwest and Florida. The types of communities that we usually buy, there'll be at least 70 units minimally, but usually much larger than that. So 100 units plus. A key factor for us is that American House could step in as the manager, or that we could acquire the current operator. We are looking at those kind of structures where we would tuck them into American House, if you will. Quality of assets also tends to be important. We will buy, buildings that maybe are C or D quality, as long as they could be made into a B or an A. But buildings that are typically already a B or an A, those tend to get us, more excited. And then also we're pretty geographically constrained. We're looking in the Midwest, Florida, and northern New England, Maine, New Hampshire, Vermont. So those are all kind of key factors for us. We're a really, really good buyer for a project, though, that has good upside, that hasn't quite reached it yet, because we do believe in our operating capabilities. And we've had a pretty good track record, so we can underwrite those cash flow improvements and factor it into pricing for the right situation. We find ourselves these days looking for communities that or going after communities that are recently developed, and the developer has gotten it to 75 to 85% occupancy and is willing to leave a little meat on the bone, if you will, and we could step in, underwrite that improvement, and hopefully top off occupancy and continue to own it. We're looking to build an operating company, so we want to build a nationwide company, and so being able to stay in long term is attractive for us. And although most of our partners are usually companies like Kelly's, so we recognize that they want to recapitalize, but usually we can work something into the agreement where we have the ability to have a buy sell or what have you.
Okay. How does it work? How does it work on the acquisition when you actually acquire an operating company? Is that sort of a double bump that an operator could be getting? They're selling their facility as well as the company, the management company?
Yeah, we haven't done it. We've done it in one situation, and so, but what and so for an operator who really wants to focus on running their buildings and doesn't want to spend the time on back office, HR, IT, accounting, the stuff that tends to monopolize your day and really not be very productive. So the theory would be is somebody who has an asset or a company or where we aren't currently, that can provide us with the human resources that we need to run those buildings and grow us and give us better reach in a different part of the country or a different service level. And then we could tuck them into American House and have them be part of our family, if you will. But it could give, we could, it gives them, we're buying more cash flow. So it could be a double bump, as you say, for the seller.
Okay, interesting. All right, I'm going to throw this out to all panel members. Who is the best buyer of a stabilized, newer asset? I'll just wait to hear from you guys.
Define best. Best price, best for the operator.
Best, very, very good question, Talya. Best for the seller. From a seller standpoint, if a seller, I should refine that. From a seller who is looking to get the top dollar and looking to cash out completely.
Chances are today.
I'm sorry, you broke up there, Talya. Say that again.
I said chances are it's not a REIT buyer today. I think we've seen all the REITs dial back their acquisitions, particularly the ones who were most aggressive on pricing. And given the retreat on REIT stock prices, I think that's going to be that's going to be a truism for a while. The REITs are probably not the top dollar buyer today, in part because they're also not typical. Many of them, including Sabra, are not a leveraged buyer looking at an IRR. So if you're a long-term holder and you're looking at balance sheet leverage, not sort of plugging in mortgage debt for today, then you've got a different equation that you're solving for. So I'll leave it to Kelly and Kevin to talk about how they see the world.
Okay.
For a senior housing owner operator who's looking to cash out and doesn't want to operate the facilities or the communities anymore, it's most likely somebody like me who is going to value the operating cash flow, and I would be partnered probably with somebody like Kelly, who's going to provide the capital. Private equity firms in the senior housing space, so outside of skilled nursing and outside of entrance fee communities, have dominated acquisitions of the last 2 or 3 years. I think 15 is when the REIT started pulling back a bit. Now, who that owner operator is, it's going to vary based on the asset type, where it's located, et cetera. Now, if they're willing to stay in, then probably they should go right to Kelly or somebody like Kelly.
Okay.
Yes.
I couldn't agree more with Kevin's especially the last part that Kevin said.
Go direct.
No, but I think that's right. If Adam, if the person's looking to completely cash out and walk away, then we would need to find a Kevin to partner with and go in, because we're going to want to underwrite that potential opportunity with someone who does it every day and not rely on our own knowledge. I would say if that's the position you're in, and we just, like I said, we're acquiring an asset next month that it is an asset we're replacing the manager. What's really important to us in order to get top dollar proceeds is to see kind of clean, institutional kind of quality financials that go back a long time. that helps a lot in boosting the value, because it creates the trust there between us and the seller, that, you know, that this has been run well for a long time and not just for a short period of time in advance of a sale.
Okay. So it's interesting if somebody is selling and they're going through an underwriting process, if there is a change out, if they're approaching a Kevin type acquirer, they're kind of going to be going through a double underwriting process. Is that fair? That it would be both American House as well as Artemis on the underwriting, and does that create additional risk during the underwriting?
Well, I'll go first, and Kevin might have a different view, but I don't think. I mean, I think my peer, kind of the peers to the private equity side. I mean, I think we all try very hard to be one face to the seller, and so if, generally speaking, if Kevin finds the opportunity and he calls me, then most likely Kevin and his team will lead the underwriting effort, and we'll kind of coordinate in the back end, or vice versa. You know, perhaps we lead the underwriting effort with Kevin's team involved on certain operational aspects. So I think everyone's going to try very hard not to have a double underwriting. That only annoys people, generally, from what I've found.
Okay. Very good. I think you covered it, but if anybody wants to kind of cover their sweetest of sweet spots in terms of what they would be looking for, where they would be willing to pay the most premium, whether it's from a geographic standpoint, a facility type standpoint, or an operator standpoint. What is your dream acquisition, and where would you be willing to pay the most?
Okay, so I'll jump in. For us, I think the place where we would be willing to pay a premium is most often a situation where we have an opportunity to do a triple net lease on a portfolio with an operator who's operated those assets and will continue to operate those assets. So from their perspective, it is to some extent a financing, as well as a partnership for growth potential. And for us, if it's an operator with whom we'd like to do business, or a region where we'd like to have a greater footprint, then that's a real opportunity for us. And those are the places where we have in fact stretched. Of course, we stretched occasionally for transformational transactions for us as a REIT. But we, in general, are agnostic on geography, so we're in like 47 states and 3 provinces in Canada. So we're spread out.
Okay.
But we focus. But most of our operators, with maybe 3 exceptions, are regional operators, and we really look to that kind of scale for growth and knowledge and insight into markets and operations.
And going back to a point that you made earlier, Talya, is that your balance sheet, you use balance sheet debt, just to kind of flesh that out for folks. So does that mean that on a transaction, you're not having to line up debt? Basically, it's your REIT is writing the check, and there's not a double underwriting, if you will, on the lender side. Is that fair?
That's correct. So what we typically do is we're able to deliver relatively an expedited closing. So we can close a transaction we run due diligence in parallel with everything else we do. So with the negotiation of all the transaction documents, from being awarded the deal to closing could be 45 to 60 days, subject to regulatory approval. So that is something that is faster than most groups, and largely because we do not have to go source capital. We have a $1 billion revolving line of credit, which is sufficient to close pretty much every deal we've had to do, and more. We have announced asset sales that are both closed as well as contemplated and underway. So we have additional proceeds coming from that we'll be able to redeploy. So capital is the easy part for us. It's like many of us right now is finding the right place to deploy that capital.
Right. Okay. And Kevin, I'm curious with you on a distressed acquisition. Is lining up the debt a challenge? Is that, or do you have a typical debt partner that you use? Is that another underwriting process?
Yeah, no, finding the capital in this market, it's been this way for a while. It hasn't been the issue. It's finding the transactions that you like and underwriting them and getting them evaluated and negotiated, et cetera. The one, it's more of a timing issue, I guess, potentially. So any buyer like me that's using leverage needs to have third parties done, appraisals, title work, et cetera. And I think most buyers would. But if those appraisals come in wrong, you may need time to address the issue. We haven't had that be a problem. I think we can go as fast as, I know we can go as fast as any other strategic buyer can. But sometimes the third parties can introduce some time. I mean, usually third parties can be done in 30 days. And they just need that time. And they've been very, very busy, over the last couple of years. But finding the debt, finding the equity, that really hasn't been the challenge.
Okay. Then I'm curious in terms of a REIT in contrasting with more private equity or owner operators. Talya, do you think that you're going to be at a competitive advantage under a rising interest rate environment? Is that going to put you at a comparative advantage to the other acquirers going forward? Sorry, go ahead.
I don't know if it'll create an advantage. I think it will. I think the question is whether it will chill some of the private equity or change pricing parameters. The other challenge, because our analysis is always on an unlevered basis, not a levered basis. The impact of interest rates isn't part of the equation of our underwriting. That's on the one hand. On the other hand, our stock price and how we're trading and what yield we're trying to achieve on an unlevered basis is. Our weighted average cost of capital is certainly a gating item with respect to acquisitions that we pursue and that we close. And that's a little different, but the math is not that different from a transaction that Kelly and Kevin would undertake when they're using a fixed rate or floating rate mortgage debt.
Okay. And Kelly, under a rising interest rate environment, are you going to have any more difficulty accessing the capital from the capital markets, equity?
I don't think it doesn't really affect our access to the equity capital. But I agree with Talya. I think the biggest question in our minds is what do interest rates do to cap rates and therefore pricing. So I don't think it changes the banks, but I think it ultimately just changes the cost of debt. Okay.
With that, I think we're going to move on to the next topic. But before we do, just like to mention that you can send in your questions, and then we'll let the panelists answer those questions at the very end. But right now, just want to go through a few do's and don'ts for the sale process, how to make sure you're maximizing your sale value for those people who are contemplating a sale. So just some things to think about. First of all, I guess right when you organize your community, it is a good idea when you line up, if you're an investor, you're lining up your operator or your management company, think through your exit and make sure that your operator is in sync and incentivized in the same way that you are as an investor. So you might find that perfect operator for that perfect community who is local, does a great job locally, helps you get a community leased up, and then 3 or 4 years later, when it's time to sell, you might find that that operator really doesn't want to step away from that asset because it's right there in its core competitive market, and it doesn't want to have to hand over to another management company one of its prime assets. So you want to make sure that you have that discussion up front. Make sure that the operator has plenty of incentive to maximize the performance of that community when it comes time for a sale and maximizing the value for that sale. The other comment is annual house cleaning. If you have a portfolio, you're managing that portfolio. This is something that we run across all the time, is that operators specifically tend to like to hang on to assets without much regard to how well that asset fits into the rest of their portfolio. You have a limited amount of resources, both human resources and capital, most importantly human resources. If you have something that is a problem property, more often than not, it may be taking 80% of your manpower, and yet on a prospective basis, the prospect for returns on that might be minimal. But yet there's a unwillingness to dispose of that asset. And if you're trying to maximize the value of your overall portfolio and make good returns for your investors, you need to go through that discipline to make sure that the communities that you're serving fit in well with the sweet spot of your operations, whether if you've got an outlier geographically or from a facility standpoint, it no longer is kind of the kind of face that you want to the market, that it's not as upscale perhaps as the rest of your portfolio. You may be damaging your brand, and it's something to think about. With that, actually, I'd like to flip it back to Talya, because they did some house cleaning with the Genesis Exodus, went through that discipline in terms of figuring out what assets that they didn't feel fit into the Sabra portfolio, and just wanted to hear her thoughts in terms of how she handled it and how they approached that.
So we looked at our relationship as a whole with Genesis and the portfolio that we had, and we came to some conclusions with respect to assets that we thought were operated more successfully versus less successfully, and had greater potential over the longer term. I mean, one of the reasons we decided to reduce our exposure to Genesis on a nominal basis, an actual reduction of assets leased to Genesis, had to do with our view about scale of operators and span of control, and the ability in Genesis's case to run 500+ buildings across the country, and we just think that's a stretch. It's a real stretch. We think Brookdale, of course, we don't have anything with Brookdale, but Brookdale has 1,000+ buildings, also is stretched. And I said earlier, our focus is on more of a regional operator. So when we set out to sell some of our Genesis assets, we grouped them in regional portfolios, and we found that there was a strong buyer's pool for skilled nursing on a regional basis, typically owner-operators, some with private equity capital or friends and family capital that back them. And we found that that is a really robust private market that is bidding for these kinds of assets that can profit from the ancillary businesses as well as the underlying skilled nursing business. So we found that market to be quite robust, and really the approach was looking at the assets we have with Genesis, what was successful, where were they less successful, and what were the regions that they could continue to be successful in versus ones that, assets that were not part of a real focus for them. So, a single asset in a state, or 2 assets in a state that were remote, were not going to be weren't going to be successful in the long term just because it was too hard to focus on them. And kind of going back to your comment, Adam, about 80% of the effort on 20% of the assets, it's really that. You can't spread yourself too thin as an operator. For Kevin can speak to that even more with greater precision than I.
Okay. Kevin, do you do any annual house cleaning, or are you pretty much on an acquisitive mode?
No, we review our assets regularly and do regular strategic planning about should we be in this market, what market should we look to enter, which buildings are the 90-10 rule as Talya was referring to, and she is absolutely right. The weaker buildings that aren't generating much value, they do tend to draw a lot of corporate attention and corporate resources, and we really don't get return all the time on those kind of buildings. Yeah, but we're continuously evaluating those, particularly with our private equity partners, and to say, is now the time? Should we refinance? Should we hold? Should we, sell outright or what have you? We have a promoted interest in our buildings, in almost all of our buildings, so we're incented along with what you were saying, Adam, drive value in those buildings, and so if we're, if it's not working, yeah, we will sell a building. It's not the right building for us any longer.
Okay, very good. Thank you. Just going through some of the other tips, just as Kelly had mentioned, having consistent financial reporting, he explicitly stated that they are willing to, they place a premium value on that. So to have consistency over time on your financials and to show strong trends, it makes the underwriting easier. So to the extent that you can have consistent financial reporting, it's helpful. Obviously, along with that, don't defer CapEx as that will help your trends. If you're consistently investing in your buildings, you'll see a more consistent trend on the revenue and the expense side. During the sale process, you do want to stay very focused on your operations and your EBITDA. We've had deals suddenly start to struggle a bit as occupancy may dip during the sale process. You want to move it as quickly as possible through, but to the extent that a smaller operator might be distracted during the sale process and allow the occupancy or the EBITDA to fall, that can impair the sale process. We obviously recommend, and I really do sincerely mean this, hire a good advisory team to help you run the sale process. You want to hire somebody on an exclusive basis. You don't want a number of brokers representing you, because then it's like having a couple of conductors running a symphony. It's going to be a mess, and this is a small community, and buyers, as they'll tell you, don't like to have the sense that something has been shopped. And so you want to agree. Who just said that?
I did.
Okay. Some other things, obviously, when you're setting up your community, putting in financing, if the thought is that you might be selling once this facility is stabilized, then be very cautious of having expensive breakage fees or lockout provisions. That can be very expensive. Then another tool that you can use if you're close on the purchase price and you need to hit a certain purchase price, this isn't for the smaller, this is more for smaller transactions where you might have a local operator who may be constrained, local operator who's a buyer, but may have constraints in terms of their capital resources. Taking back paper might allow you to get over the hurdle. I don't think any of the panelists today have any challenges with regards to their access to equity, though. Let's see. And then in terms of just very quickly in terms of timing on selling, one thing is it's always a good idea if you've got a stabilized community. Only bad things can happen once that community is stabilized, so you may consider selling upon stabilization. That said, if you have if you're anticipating some external shocks that you may not be able to sustain, for example, you're maybe undercapitalized, and you see a big competitor coming into the market, spending a lot of money on the marketing, and you think that you may not be able to compete so strongly, and you need a stronger capital partner, that might be something you consider in terms of a sale, or at least reaching out to find a new capital partner. It's always a good idea when you've hit your targets to look at a sale. We talked about the outliers and the disposition of outliers, and when you're in a shrinking market, for example, that's another thing to think about. If you're in a market that has declining demographics and perhaps declining census, that's something where you're not going to want to spend a lot of your resources in terms of investing in that particular community. So with that said, any parting thoughts from the panelists in terms of what they're looking for in 2008, looking forward to in 2008, thoughts on what the market will be looking like in terms of what you're going to be looking to buy, how aggressive you're going to be looking to acquire? Last thoughts from the panelists, maybe starting with Talya.
I think we're going to be looking to see if there's any movement in response in cap rates to change in interest rate environment, and whether that creates a change in some of the buyer interest, because while we're dedicated to this space, a lot of the private equity capital looks at other investment opportunities outside of senior housing. They're not necessarily all dedicated to senior housing the way long term the way we are. So that's one thing we're watching and out for and really tracking. The other thing we're looking at is when the opportunities for development deals that have gone sideways, where our lease up has not hit 95% but is stuck at 75%, whether there are going to be opportunities that arise out of that for someone like us. It certainly could be an opportunity for private equity if they're interested in that. It could also be an opportunity for Sabra. So I think those are the things we're looking for, to see how much pricing and the buyer pool changes, and how projects that have started with lofty goals but have kind of hit the skids change. So the final thing we're looking at is to what extent some of the shorter hold money is going to start to exit some of the assets they bought, call it 5 years ago, 3 years ago. And that's going to vary. We're already seeing some of that happening, and whether they have realistic expectations on a sale price or whether they're or not.
So are you characterizing those folks? Are those folks that really are more real estate oriented multifamily investors that you're talking about, or just shorter term investment horizon?
No, I think we're seeing the usual suspects that have in private equity sell move assets for a variety of reasons. Sometimes you see it out of vintage reasons, sometimes you see it out of just recapitalization issues, and sometimes the projects have underperformed, and if you're patient they may perform, but sort of the hold period creates a drag on IRR, and so there is a time limit oftentimes.
Right. Okay. Kevin, what are your thoughts? Any thoughts for 2018 and the targets?
We continue to be bullish on the sector and continue to be, have a very healthy appetite. Where I suspect that I'll see more opportunities, and I'm already seeing more opportunities along the line of what Talya was saying, was developers that were in the business and saying, okay, now's the time to exit. We really don't see a future for this, and we've made our money. Now we're ready to move on. We also suspect to see more developers that don't make it, so failed development projects or even failed construction projects that are half built, that are more less predator driven. Those dispositions. I think those are still far away. We are, we also continue to watch occupancy issues associated with new development. That's the biggest issue, I think, right now, even way more so than interest rates. And then also labor is an issue that we spend a lot of time studying in every deal that we do, because it's hard to find quality staff throughout all levels of the community, all levels of management of the community. It's hard to find staff.
Very good. Kelly, any thoughts?
Yeah, you know, look, I think 2018 is going to continue to be a great market for sellers. And I think if you're looking to change your capital structure and find a new partner that you want to grow with, it's a good time to do it in 2018. I think the capital is there. But look, we're really excited. There's obviously some potential headwinds that I think Kevin and Talya mentioned, but there's also a lot of tailwinds still for the sector. We'll continue to be active.
Right. Okay. Very good. We're running a little bit short on time. I think we've got time for maybe one question from the audience. We do have a question from the audience. I think it's probably, I'll ask Talya to answer it. Is there currently a premium on multiple acquisitions versus a high quality stabilized single asset? Are you willing to pay a premium for a multiple acquisition?
So I think a few years ago, you definitely saw REITs and others providing premium pricing on portfolio, particularly large portfolio transactions. I think that has compressed. I don't think if there's a premium to portfolios, it's de minimis at this point. I think there are enough buyers out there that are quite aggressive at the smaller end of the scale in terms of dollar cost, and as well as on the larger end. So I think the premium is compressed.
Okay. Thank you very much. I want to thank our panelists, who I think did a terrific job in terms of comparing and contrasting the different types of buyers that are out there. These are all very strong buyers, but each has their own unique characteristics, and it's I think helped educate folks who are thinking about a sale and teeing up a sale. Appreciate the audience. Thank you for your attendance, and we'll hopefully see you guys soon. Take care. Bye-bye.
Thank you.